Good afternoon, everybody. My name is Colin Day. I am a financial advisor with Correct Capital Wealth Management. Many of you may be joining us because we are your financial advisor on your 401k plan or as individuals in our firm. And we do this type of presentation every quarter for our folks to make sure that we are talking about topics that we feel are very time appropriate because we want to make sure that we're talking about the things that interest you. So in the future, if you ever have questions or things that you would like to talk about or things you'd like to hear about in a presentation format, please do let us know because we take your feedback and that's what we do when we create these presentations for you all. So the topic du jour is preparing for retirement in a bear market. So we'll talk about what a bear market actually is in a moment. But the reason that we want to talk about this is because just how the market has performed over the past month and a half or so has been very different from what we've experienced the past few years. Even when we think about the throes of the COVID response in February, March, April of 2020, things greatly improved. So when we look at it on a calendar year basis, things actually worked out pretty well for most investors in that year. But we want to make sure that we're taking an educated approach so that when things don't go quite as well in our accounts, that we still feel empowered to make good decisions, that we can still do the things we like to do, like many of you might be considering things like retirement, to make sure that we have a semblance of a structure of a plan so that when things aren't going according to plan, we have other avenues to consider, and we have structured our investment accounts in a way so that we can have success even when things are not performing the way that we would like to. So again, we're going to talk about what a bear market is and what it means for you, especially for those of you joining us that are soon to be retirees. And then we're going to use an income planning structure to kind of talk about how we work with individuals and couples to make sure that we're making good decisions now before retirement and then into and through retirement as well. We'll talk about some additional considerations where in an example that we go through where some things might be a little bit different or we have to give some nuance to your particular situation. And then at the very end of the call, we'll have time for questions. So if you have questions in the interim, we're a small group, but I would appreciate if you could just type in the chat if there's any particular questions that you would like me to address at the end. If it's easier for you to voice your questions at that time too, you can unmute yourself and just say, hey, Colin, and hopefully we'll get to your question. If it is more personal, please just shoot me a note, give me a phone call, be happy to go over your personal situation as well. So that being said, bear markets and you. So you may have heard these terms before, bear and bull. Bear markets are bad, bull markets are good. But what does that actually mean? Well, a bear market is when an index has dropped 20% from a recent high. So, and what I mean by market it is mostly when we deal with separate indexes. So you may have heard of the S&P 500 or the Dow Jones Industrial Average. There's hundreds of these things, and they all focus on different areas. Some is US based, some is international based, some's based in different kinds of securities like real estate or our bonds. But what we really focus on is that it's a dramatic fall from a recent high. I think that's probably the best way to put it. Now, the most recent bear market was in 2020. And if I actually show you the next slide, it was very brief. You can actually see in that red box over on the right what I'm talking about. If you've attended one of my presentations before, you will know that I really love this particular slide from First Trust because they update it quarterly, and it talks about bull runs and bear markets on a timeline. So on this timeline, the blue is good. Those are the bull markets where things are going up. The yellow are bear markets when things are not going so hot. So we like the bulls, we don't like the bears. But what you'll probably notice here on the slide is that there's a lot more blue than there is yellow. And that's good. That means that the market generally goes up compared to the market always going down. And like I said before on the previous slide, when we look at the most recent bear market, it was that 1.1 months over here on the right where we have that dramatic fall. And this is representing the S&P 500, which is big US companies. We can see just how dramatic that fall was, but how brief that bear market actually was. Again, we fell 20% from a recent high, and then over 1.8 years, we saw a lot of success until the end of the year. And then pretty much, let's just call it since January, things have not been going quite as well as we had hoped. But the point is that bear markets are very short in comparison to bull markets, and they are not as pronounced. But the reason this becomes more of a conversation topic for soon-to-be retirees is because bear markets are more impactful on our decision-making than bull markets. And that's all part of what's called loss aversion. It basically just means that when things aren't going well for us, we tend to remember and reflect on those more so than when things are going well. It's like when you have a really good day at work and that one guy cuts you off on the highway, and you have to slam on your brakes, and that's all you remember from the day is that one jerk. It's that same kind of concept when we think about the markets and how our investments perform. We can quickly forget that, we've had really good markets for several years because something bad is happening or something's on the horizon that's not going to look good. So when we think of this loss aversion strategy, I like to show the slide because I think it does a really good job explaining it. But it's also to say that, hey, if you're going to cut your retirement cake and you're in the midst of the bear market, you might have some concerns. Because if we move on to the next slide, we can see, psychologically, a bear market does great damage to the health of our retirement accounts because it sometimes promotes unhealthy behavior, namely making a lot of investment changes at probably not the appropriate time for yourself. So we have to control these urges to make these changes because we know over the long term, it probably benefits us more to not make decisions or not make rash decisions on our investments when we would be better off making educated responses and having our hand steady to the flame, so to speak. So we want this money to last and we want to be concerned about the market, but we know that, between now and your retirement, and then from retirement on, we could be talking about 40 plus years for all I know. So we've got a time period where if we have to be concentrated on the market, but then we have to have this money grow over long periods of time, we have to balance this, what we call investment risk and inflation risk, because as much as many people want to throw their money just in the money market fund at their bank, we know that, we're not going to be able to compete with inflation if we do so. Or on the other end, if we throw all the money into the market, we're going to have investment risk because things aren't always going to perform well. And we're going to still have to make withdrawals out of our account to fund our lifestyle. So it's this idea that we need to make sure that we are comfortable with risk in retirement, because as the slide shows with Fidelity, because inflation and specifically healthcare cost inflation is so high, we have to have some kind of risk in our portfolio at all times throughout retirement to balance out with what's going on, whether it's a positive or a negative opportunity in the market. So you can see here, like a conservative portfolio, which Fidelity is describing as about 20% stocks and 80% in bonds. And then on the other end of the spectrum, 85% stocks and 15% bonds. Those types of portfolios over long periods of time generally earn great long-term returns. But it's how much risk are you willing to put in as the investor, knowing that, again, we can't throw everything in cash because we're likely to run out of money a little bit too quickly. So income planning. I want to spend majority of our conversation talking about the structure of how we think about our assets once we get to retirement, because this is how we control ourselves so that when things aren't going well in the market, we know that we have a plan in place and there's reasons for how we structure the accounts the way that we do. So income planning is this concept or this idea that we're going to help take your retirement wealth and deploy it to meet your goals, which is exactly why you fund a 401k plan, or you save in an IRA, or you put money in the bank, whatever it might be. It's this idea that then once we have all this money, what does it mean for us to not earn a paycheck any longer? How do I replicate getting paid in retirement to make sure that I'm not going to run out of things in the future, or I don't feel like I have control over my finances any longer because I'm used to receiving a common paycheck? So we're going to think about when we are using the money in our accounts from an investment standpoint, and then how we think about investing that money purposefully in different kinds of assets. So again, it's all about being intentional with our money. So there's particular reasons why we put money where we put them and why we invest in different things in each one of these, as we're going to see right here, buckets. So it's a very common idea for financial advisors to use buckets, but every financial advisor has a little bit different way of utilizing bucket strategies. And this is my personal way of using them. So what you're going to notice here is that we've got three different buckets. The largest one is generally your growth bucket. The intermediate bucket is income, and then we've got cash. So these three buckets kind of formulate this income planning strategy and why we put money where we put them. So if we actually start at the bottom, you'll notice that there's a cash bucket. And I say 12 to 24 months, we'll talk about that in a second. But we have cash on hand in our bank account, in the checking account, in savings, and that's for our immediate expenses. So in these immediate expenses, we're thinking, okay, I've got to buy groceries, I've got property taxes coming due, I've got car payments, whatever it might be that I have to pay for regularly. And then of course the water heater breaks, and it'd be great if I had the cash available so I didn't have to dip into my investments, whatever it might look like for you. But this is the money that's on hand to take care of everything immediately. In the intermediate bucket, that middle bucket, what we call income, this is the income stream in retirement. So this could be simply your Social Security checks. This could be your pensions if you're eligible for one in your current or previous work. It could be annuities, or it could just be conservative investments, which are offering some kind of interest rate return like bonds might. So within this bucket, we're holding on to a little bit more money because it's not immediately needed like our cash is, but we still want this thing to grow a little bit and compete with inflation. So we're being purposeful on if we have to invest some of this money in this income bucket so that we can produce returns that are at least matching inflation, if not exceeding it. Then finally, the third bucket, again, generally the largest bucket, is called growth. So this is the long-term bucket. So we want this to be our long-term related investments. And so because of that fact, it's likely to be the most aggressive bucket of the three. And so this is where we might hold on to mutual funds or ETFs or stocks, those types of instruments that are generally going to have the greatest growth potential over time. And so what you'll notice through the example we're going through is that we've got these three buckets, and the reason they're kind of stacked the way they are is because eventually, as we incur expenses and we get through the cash in our account, suddenly we're not going to have as much cash because we spent it all. So we have to take money from that income bucket and refill the cash bucket. And then the income bucket's going to look a little bit light then, and so we have to go to the growth and pour a little bit into income. And again, the growth bucket is really the driver of the entire plan. It's kind of the engine of the plan because this is where all the money hopefully is being made. All the risk is being taken up here. And so because this is the one that has the most potential for growth, it has the capacity to continue to fill up these buckets throughout your 30, 40-year retirement. So we'll get into an exact example right here. So let's start talking about Julie and Bob. So Julie and Bob are going to retire next year. So they've come to me as their financial advisor, and they have questions on, hey, we've got this wealth, but we don't know how to deploy this so that we can have a successful retirement. We've done a good job saving. We have some opportunities out there, but we have no idea how this money works for us in retirement. We need an income plan, which is great. So when we think about, oops, sorry, I'm getting pinged. When we think about their money in their workplace retirement plans, and this is what we're going to keep it simple. We're just going to say they have money in their 401k plans because that's where the majority of Americans save for retirement in the first place. We have to figure out how to deploy that. Julie's very concerned with market volatility, so she's a little bit risk averse as she's approaching retirement. Well, Bob is more concerned about the money lasting for their whole retirement. So they want to make sure that the money is there for them, while we also have to compete with Julie's needs, which are making sure that we're not too aggressive over time. And so this is where the income plan is going to come into place. So just a little bit behind the numbers for Julie and Bob in this hypothetical scenario. Let's say that they have $1 million between the two of them in their retirement plans at work when they retire. Social Security at retirement, so fast forwarding a year forward, they think Julie can get $1,500 a month, Bob can get $1,800 a month. Now, Julie also has a pension from previous work, so she's going to get $500 a month from that pension plan. And they believe that they need about $6,000 after taxes to fund their retirement. So annually, they'll need $72,000 a year. So you can already start to see some of the structure come into play because we've got money to be able to invest. We've got a lot of guaranteed income between Social Security and that pension. And we have identified the actual dollar amount that they're going to need regularly. So let's dive into the buckets then. So in this case, Julie and Bob, they need resources for their regular expenses, like I talked about before, mortgage, utilities, car insurance, groceries, those types of things. So we need to make sure that they can pay their bills throughout the year. So we would like them, as their advisor, to have somewhere between 1 to 2 years worth of expenses in cash, net of any regular income. And what I mean by that is that gray box over on the left. So they have a monthly income need of $6,000. They think that Social Security is going to be $3,300 a month between the two of them, and then the pension's another $500 as well. So their guaranteed income total is $3,800. So that's the amount that they are going to receive every single month. Now, there's some pre-tax stuff, there's some after-tax stuff here, but we're going to go with these numbers for right now. So $3,800 a month is coming to them, which means they still need $2,200 a month to cover the full $6,000. Okay, so that $2,200 a month has to come from somewhere. And in this case, it's going to be in their cash bucket, likely at their bank. So their cash bucket, they've decided that they want to hold on to 2 years worth of cash. And that's fine in this case. So they need to have $52,800 set aside in their bank account between maybe a checking and savings or money market or CDs, something that is relatively liquid that they can gain access to within a reasonable time frame. But that's the amount that we want to have right there. So when things go wrong in the market, when things are, looking really gloomy outside, when you think about watching CNBC or looking at the news or whatever it is, we want these two to feel really confident that they've got everything that they need for the next couple of years. And so they can breathe easy, because regardless of what's happening on the outside, as long as we've got the 2 years to cover ourselves, we've got plenty of time to incur whatever happens out there in the market, because we have the cash on hand to pay all of your immediate bills. Okay, so that's a cash bucket. So then the income bucket, the middle bucket, is the bucket that is going to be the income payments, so the guaranteed income that they're already receiving, and then probably some conservative investments. Like for them, it might be a fixed income portfolio full of bond mutual funds, or it could be, they could be interested in something like an annuity if they're looking for more guaranteed payments. But it depends on what they're looking for as to what we as advisors might suggest for them to consider. And again, this income bucket, being the middle bucket, will eventually refill the cash bucket once the cash bucket gets a little bit too light. So in the income bucket, generally speaking, we'd like to have approximately 10 years worth of expenses net of any regular income in this middle bucket. So if you recall, in the previous bucket, in the cash bucket, we needed to produce $2,200 a month for Julie and Bob. So if we're looking at 120 months, which is 10 years, we need to have in the middle bucket about $264,000 in there. Okay, so in that bucket, again, this could be, their traditional IRAs, annuities, still, it could be conservative investments like bonds, but that's the middle bucket right here. And so this provides us then with the flexibility to, again, tilt the bucket and refill the cash coffer when they feel it's getting a little bit light. So then finally, when we approach the growth bucket, again, the largest bucket in this case for this couple, this is the longest term bucket. It has the greatest potential for appreciation. And again, it's refilling the middle bucket, the income bucket, which will then fill up the cash bucket. So all the other funds in this case is going to end up over here. So cash bucket, $52,800. Income bucket's going to be $264,000. So total already reserved, already set aside is $316,800. So if they had $1 million in their 401k plans, we know that the growth bucket portion is going to be about $683,200. So that's the portion that's going to be in that growth bucket. So if we think about a percentage of their account, because they started with $1 million total, let's assume they had nothing in the bank at that time, they had $0 in there, about 68% of their money is still going to be focused on growth. It's still going to be in those more aggressive securities like stock mutual funds or ETFs. So what type of account they're held in is not that much of a concern. But these could be things like Roth IRAs. They could be your brokerage accounts where you have long-term capital gains opportunities, which might be at a lower rate than what you're going to experience if you get taxed at ordinary income. But in essence, what for the concentration today, again, this is the largest bucket of the three. This is the one that refills the income bucket. This is where we're taking the opportunity to be aggressive, and we're being intentional about this. And as we can see, as this breaks down between the three buckets, we can see how the growth, the income, and the cash then will work. So again, it all starts with cash, being able to pay your bills. Julie and Bob may say, hey, we want to have at least a minimum standard of 1 year, but we're going to start with 2 years worth of cash available to us. And then as that starts to get drained over the course of the year, they give a call to Colin and they say, hey, our cash bucket's a little bit light. We need to figure out how do we refill this coffer. We analyze the income bucket, we produce cash, they refill that bucket, and then we rebalance portfolios to make sure that the growth bucket is still working, but we start to reposition some of those assets back into income to refill what we had to send to cash. So this concept, this idea might be foreign to you if you haven't seen this before, and that's perfectly fine because it can be kind of hard to conceptualize how we use a pot of money in retirement. But this is a tried and true method to get people through retirement, and then also to not worry about those bear markets quite as much. Because again, when things aren't going well, we already have in place a safety net of cash already available to you at a moment's notice, so that when the coronavirus happens or when a huge market recession happens, we have the opportunity to say, we have the cash available that we need right here. So the market can do whatever they would like, for the next couple of years. We have an income bucket, which is generally pretty conservative. So even if everything's going haywire out there, and again, you're watching the news or you're reading up on financial reports and you're seeing everything is hitting the fan, you can feel relatively confident that you've got a more conservative bucket that's going to refill that cash coffer. And yes, we still have the growth bucket, and that's probably the part that's going to get hurt the worst in this case. But again, according to your risk tolerance and how we invest you, we have these other buckets in place that are already more conservative. So you can rest a little bit easier knowing that the structure has already been in place and we've been intentional on how we've constructed it so that it will meet what your income needs are. So the additional considerations, so here are the caveats with this, is that, so first of all, the amount in the buckets is determined by how much has been saved and what needs to be spent. So if, Julie and Bob came in with $500,000 and they plan to spend $72,000 a year, we might need to reformulate these buckets a little bit because we only have half the wealth of what we assumed. And so because of that, we might not have the ability to produce $2,200 a month in income. We might have to shorten the cash bucket to be able to produce more long-term growth opportunities to refill the income and the cash bucket eventually. So if you have larger cash bucket and bigger expenses on the horizon, or you want to have a bigger emergency fund. So let's say you're going to buy a car, you're going to go on a huge vacation to celebrate your retirement, and you need more cash besides the 1 to 2 years that we just talked about. Well, now we're in a situation, again, cash is a lot larger. There's not a lot to work with then in the income and growth. So we have to take that into account. And then of course, the investments in each bucket are determined by risk tolerance. So if we're looking for absolutely no risk, we might be in very limited situations in terms of how we can even use a growth bucket because you might not be willing to put things at risk. And by doing so, we might be at risk of running out of money for our retirement. And then finally, we have to consider changing costs in retirement. So, especially the increased spending on those first couple of years of retirement, which may say, hey, we need a little bit more cash, but maybe we can move that down as you don't spend quite as much as we generally age and spend less money in retirement. So, but these kinds of considerations I put here is because while it might be easy to kind of formulate what I just showed you with Julie and Bob in your own heads, there's lots of caveats that can come into play that can mess with the actual numbers that you'll need to consider. So if you have personal questions about this presentation or how you might structure these kinds of buckets, please feel free to reach out. This is a very specific conversation to you and if applicable a spouse to make sure that you're running your portfolios correctly so that you can make these anticipated changes if necessary, but then also to give yourself, again, the peace of mind that you feel really comfortable heading into retirement, knowing why your accounts are structured the way they are.